Okay, welcome everyone to the Hurley Investments podcast. This is where myself and he's on the other line. Can you introduce yourself?
Hello, Kevin. It's Michael Verdon here. Glad to be here.
Michael Verdon's here, Kevin Hurley. We're going to talk a little bit about our stock market today. Give you guys some thoughts on what we're thinking, what we're seeing, how it might affect your stock positions, and really give you a little information of what we spend our time doing day in and day out. I think it's kind of funny because some people think, well, most people think, and they're right, hey, my broker's taking my money, and guess what? Their job stops. They're done. They've taken their money. They're going to put it into something, and the canned answer is, hey, don't worry. You're in it for the long haul when your account's down by 50%. Well, we don't do that. We're in front of the market every single day. We're discussing what's happening and why. We also take the advantage or take advantage of the ability to really ensure your stock positions. Make sure that if stocks are heading down, that we can make up some of that downward movement. Today is probably August the 16th. I think it's a Tuesday.
It
Which
is.
means, yeah, I'm right there, huh? It's August the 16th, it's a Tuesday, which means we have some economic reports that came out today, and let's go through what we see in the market and why our market keeps rocketing to new highs when, in all reality, we keep achieving new lows on earnings quarter over quarter. Any comments you want to throw out there to start off, Michael?
Yeah, the overarching theme that I'm looking at and have continued to look at for the last month or so now is what's going on with bonds overall. I'm looking at the 10-year now. 10-year yield is up, meaning bonds are selling off today, which is kind of surprising given we were down pre-market pretty heavily. Markets rebounded somewhat, but looks like a lot of these dividend payers, these fixed income proxies that I've been so focused on, are starting to sell off. Maybe as people think the trough in earnings has come through, maybe we're going to have a little better earnings environment going forward. So uh, that's really what I've been keying on. So and all the economic indicators and reports you're talking about are probably going to go to that. So it's kind of my base case of where I view the world right now. So what are you looking at?
Well, if I can make a comment on bonds, it's funny because bonds are inverse, or an inverse, how would I say it? They're an inverse investment to the stock market. The stock market is going down, you plan to put yourself in bonds that are going to be going up. As the stock market goes up, usually you see a decrease in the premiums paid, the interest paid, and or possibly the par value of your bond. You could see that, it's just opposite of the stock market. It's been really interesting that we haven't had a divergence of bonds and stocks. They both have been going up. And it's funny because as obviously Michael and I have talked, I've sat there and asked him, what's going on? When was the last time you saw this? When can you go back in time and see that the bond market, that the stock market, that the energy markets are all rising tandem with some of the international markets as well? And obviously the answer is what? $14 trillion of stimulus and quantitative easing and asset-backed investments. I mean, we're seeing an unprecedented amount of money being thrown into the system right now that well, here's how I put it. You can't tell me that our market isn't based on a house of cards and that all the way across the world, their markets aren't being propped up by not earnings like it should be in the stock market, but by easy money. Send that easy money out there to see what's going on, to see how it's going to help or benefit, or in all reality, in some countries like Japan or China, just how much inflation they can create. Hey, out of curiosity, how bad do you think inflation is going to be sometime in the future, whether it's stagflation, inflation, deflation? What are your thoughts on that, Michael?
That's pretty interesting. I think what's from the policymakers' perspective, I think they view the world as in a deflationary environment, but that's with an asterisk because normally, if you take just the indebted sovereigns around the world, when most entities are indebted, just as a balancing mechanism in a free market society, what the way the mechanics of that work is if you're in too much debt and you want to go borrow more, you're going to have to pay a higher interest. So it impedes your spending. So there's that balance that always comes into being. So if you look at the Japanese JGBs or even the German 10-year, it's they're negative yielding. So even up to the 30-year in Japan, so you're talking people are believing from a historical standpoint they're going to have 30 years of deflation. I just can't believe that's possible at all. So what's going on there, I think, is these central banks around the world are buying such a huge float of the treasury market, obviously to drive these treasury prices higher, to drop yields, to try to spur spending, that we don't actually live in a free market in that sense anymore. So there's a disconnect between historic ways you view the world from fixed income and what's going on and how that's affecting the markets. So what's happened is as these central banks have bought such a huge float of treasuries, people that have historically invested in fixed income are they're all piling into the market. I consider them like fixed income proxies, these high dividend paying, high quality stocks. So, and I think that's just the central premise of what's been happening in the market in the last year or two, is as people can't get the yield they need to provide the income for their investors, they're all buying these same stocks. And so what's going on now is everyone's in the same stocks, the utilities and the telecoms. They're the best performing sectors this year, which if you think about it, people buy those sectors historically for safety. So this is what's been leading our entire market. So the things that have historically been the safest investments are now probably, if you believe this growth story in the market in the trough of earnings, now they've become probably some of the riskier places to be. So that herd mentality that you and I talk about so often, the herd's now in the safety trade, and it seems safe until it's not, and then everyone wants to exit. And there's one door, and everyone wants out all at the same time. So that's just kind of the whole box that the corner the Feds painted themselves in, is how do you raise rates without kind of destroying what they've kind of done in the stock market. And I kind of view the stock market, if you want to, like in '08, I mean, they used housing was the big asset inflator and the wealth effect that was created, and people felt richer and spent more money. Well, I think it's being done now. They've kind of solved that by buying all the MBS off the banks and lowering rates and just keeping rates uber low for a long time, and which is great because you can buy more house for the money. So they've inflated that asset that way. But through the dynamic we were just talking about, they've done it in these dividend-paying stocks now. So
Hey, Michael, have you ever seen what happens when you put a lot of beef through a small opening?
I have.
Comes out as hamburger, right?
It does.
I honestly, the way that you just said that, the way that you just said, you know what, the savers, the fixed income are all being pushed right now into the stock market, and their proxy for their bonds, since the rates are so low, have been these dividend paying stocks. I circled here in front of us the CPI, which is the consumer price index, or the core CPI, which is they're both inflationary measures. Look how low they are, comparatively speaking. Yet, obviously, energies have been a big push there. I was going to just take a stock really quickly, and I was thinking of ExxonMobil. Uh, I kind of feel that most of the people that are now piling in have missed the run up. If you take a look at ExxonMobil, it got pushed all the way down to the 60s from 100. But look where it ran back up to. It ran back up to that 96. Right now it's sitting at 87. A lot of the run has already been taken, or you've missed the run literally in some of the energy, that's CVX, and some of these bond-like stock positions. um, you've missed the run up already. You can see on the charts how you had the opportunity for the 70s for a lot of the the oil stocks. The run's already back up, and the funny thing is, the run's back up to the $100 range, for example, in Chevron, for the $87 range in ExxonMobil. We could do ConocoPhillips in here if we wanted to. You're going to see the same thing chart after chart after chart. The run has already come up. That's Coach. ConocoPhillips is what? COP?
Been a long
CHP
time.
maybe? Although, of course, 90% of the markets, there it is, down from 30 up to 42, and it did get as high as 48. In all honesty, you're going to see these all the way across the board, whether it's Devon Energy. The run has already been made. So the people that are piling in now have missed the bounce back. I could even go to Dominion. Um, it, you missed it. You missed it. And I feel sorry for those people that are now running into energy-like positions because when you're at an all-time high or a top, Michael, where do these positions usually head to after that?
That's exactly right. When everyone's all in, where else can you go from there? It's, what you're talking about in reaching these tops. I think a lot of the rebound in the earnings in the overall S&P have been a result of the recovery in the oil sector and the oil service sector. Um, what's going on now, a lot, I think, with these dividend payers is as they're being treated as fixed income replacements, a lot of what they're at such a high price that their multiples, their PE, their price to earnings are higher than they've ever been. I've got some charts. I've been trying to do as much research on this as I can, and I've got a couple that go back as far as 2000, a little before 2000. They're 30 to 40, and in some cases up to 50% higher from a price to multiple standpoint, from a valuation perspective, higher than they've ever been. But nobody cares because when the 10 years yielding 1.57 right now, and you can buy some of these div payers at 3-4%, well, it's a great deal because it's a relative trade because people have to have some money to live. And so no one's even looking anymore about the true cost of these investments. They're just looking at the yield. So I think the danger is if it's actually possible that we get a little inflation and the Fed has to raise rates for whatever reason. I mean, I still think that that's not a likely scenario, and I've been saying that for years, that rates are going to continue to go lower, and it's more of a function of the interest expense on the debt and having to pay that. So how do you increase your debt from 10 trillion to 20 trillion and still pay the same amount of interest a year? You keep dropping the rate. So it's more a function of that. But
If I can
when
make a quick comment in here on what you're saying is we're in an unprecedented time where the valuations or the standards to measure the stock market are irrelevant. There's so much money pushed into the system to, as you just said, to continue to borrow money at a low or insignificant interest rate. Kind of funny to say insignificant on what, 10 trillion, 13 trillion dollars that's borrowed, um, to make it what's considered by most an insignificant interest rate. It is amazing, absolutely amazing at at the fact that there's not any way to measure our stock market that doesn't say, oh my gosh, it is so built on a house of cards and so manipulated by the Fed right now. Grandma Yellen is doing such a good job of of uh, of being behind the scenes, kind of the Wizard of Oz, right? Being behind the scenes and pulling the levers that make the market do what they need to do. And of course, somewhere down the road, we're going to have to pay the piper. Somewhere down the road, we're going to see deflation like Japan for 30 years, where your money isn't worth anything. Your money doesn't grow. Your money isn't valued that it should be for a 30-year period. It's unprecedented. It's one of those 16, 17, 18 things that we've never seen in our stock market before that's occurred since 2008. Really shocking to see that standard metrics that we used for decades and upon decades to measure the value, the worthiness, the importance of the value of the stock market, good entry, exit points. None of that matters. None of it matters. It's irrelevant. Doesn't
and
it?
you're
It's a, It's not important anymore.
You're exactly right, because you know what? Back in the day, the bond vigilante guys would come in and set the price and help regulate the price of money. Nowadays, I mean, you said just a second ago, so we're in these unprecedented times, and sooner or later the Fed's going to have to, you're going to reach the end of that road. So my question that I'm always trying to answer is, when is the end of the road? When does that come? So I don't think that our central bank's going to have to do anything for quite some time. You have negative yields in Japan. In the EU, Mario Draghi's ramped up QE again and dropped the rates, and they're buying everything in sight. They're buying not only just sovereigns, but corporate debt now, which to me is just a fascinating development. I would like to know, or I wish I could be behind these closed doors. I want to know who makes the decision which corporates they get to buy. I think that'd be a real fascinating discussion to listen to. But since they have negative yields, so say you're in the EU, you have Kevin Hurley Bank and Trust or whatever, and you have to buy some AA paper. Where are you going to go? You're not going to invest in a negative yielding asset. You're going to come to the U.S. So our 1.58 seems pretty low until you're looking at negative real yields over in the EU or in Japan. So I think what's been going on recently is the Fed doesn't have to do anything because people around the world are piling in buying our debt. So I think this, look, you can continue to spend more and more money as long as you keep dropping the rate lower and lower and lower. We're going to be the last line in the sand on that call. So eventually, you can't go. The whole world can't go negative. So although we can still go lower, and I'm sure there's going to be reasons and excuses that the Fed will find to go lower. But for now, I think what the dynamic in the market is the market seems to believe, or appears to me to believe, that there's going to be higher growth in the future. And as rates have dropped lower, I think the first of last month we hit 133 on the 10-year, and we bounced pretty hard off that. And ever since then, these div payers have seemed pretty unsteady. They've been selling off. They're starting to roll over. As I think the predominant feeling in the market is that there's going to be growth return. So I think there's a secular uh, move out of these div payers and into the more the valuation plays and the high growth stocks. So
Well, you don't need to think. If you just take a look at the metrics and how money shifted, moved, you are 100% correct. Well, hey, to end on today, you made the comment that the road is going to end. So let's just predict right now. And I'm going to go to one of my favorite movies of all time, Back to the Future. Where does that road always end?
I'm not
In the
sure back
first movie, the road ended smashing into a bank. In the second movie, when they get in their western, the road ended going off a cliff. And in the third movie, it's kind of funny when they get in. Hey, Doc, you'll never make that 88 miles per hour. He goes, roads? Where we're going, we don't need roads.
you know
Boy, does that sound like the Fed, huh?
that is so
Uh,
funny you would say that, because I've been thinking a whole lot about, you've been here and they've been kind of leaking a few things here and there about helicopter money. You've probably, I'm sure you're familiar with Ben Bernanke's speech back in the day, and which just this whole notion of what our money actually is and the way they fund money through, or our debt through selling bonds and whatnot. So that's another discussion that's probably longer than we want to have right now. But how we fund our debt is going to be a topic going forward. But anyway, look, it's been fun. We always have these discussions pretty much every single day anyway, so maybe there'll be some use for some folks.
so let's put it on out. We'll email us out to the individuals, make it public on YouTube, see if we get some more of the followers out there. We'll have this retweeted out to a couple thousand people. But hey, I appreciate you being here today. I'm much like you, and I hope for those that are joining us for the first time that your financial planner or advisor or your money manager is taking the time like we do on a daily basis to look at what's happening in the stock market, to look at your own personal account, to decide based on simple technical analysis. It doesn't have to be anything major, but just to decide on, hey, what do we do to help protect our clients' money? That road, it doesn't end well. We've seen it on a much smaller scale with individuals and businesses that overborrow and that can't pay their debt. We all know it's a dead end road. It's a road going off a cliff. And boy, it just seems like the chasm or the deepness of that canyon is growing day by day by day by day as we try to kick that can down the road. I appreciate being with us here today. Um, we have some phone numbers there. We have some websites there. We have a way to reach us through support at Hurley Investments. If you would like to talk to us one-on-one, or you would like to just discuss where your money's at, how you can get it over to Hurley Investments, how we protect, please give us a call. We look forward to talking to you. Michael, thank you for your time today,
Good
and let's
time. I
get this
appreciate
app
being here.
posted. Thank
All
you
right,
very
buddy.
much. Bye-bye.
Bye bye.